All right, for chapter 12, we're kind of taking the different cash flows that we used in chapter 11 and we're calculating them out into detail by cash flow. So take the time to watch my YouTube video for which would be number 8 in your problems, and that will help you because I work everything out on the board and I talk about it. I'm going to also, number 9 would be another one that I would do in class, so I'm going to bring up the solutions here and talk about that. So basically, number 9 is saying that we have a new proposal to purchase a milling machine. It has a base price of $108,000 and it has shipping and installation costs that are going to add another $12,500. It's a 3-year class, so that means the depreciation rates are 33%, 45%, 15%, and 7%. After 3 years, it can be sold for $65,000. It would require a $5,500 increase in net working capital, which would be inventory less accounts payable. And there would be no effect on their revenues, but their costs would decline by $44,000 a year. Their marginal tax rate is different on this one. It's 35% instead of 40%. And their weighted average cost of capital is 12%. They spent $5,000 investigating the possibility of using this machine. So then the first thing it says, okay, how should that $5,000 be recorded? So we know that that is expensed as it's incurred. So any of these project related costs in researching, or, like in the real world, sometimes you have to send people out to look at the different things. All those costs are expensed as they're incurred. So we don't capitalize those. Okay, then the next thing it says, okay, what's our initial investment? So our initial investment is going to be what we put in our cash flow in year 0 in our cash flow function. So it costs us $108,000 to purchase this new machine, but we have $12,500 of installation costs. So here you can see we have to add those together. So that is going to equal our total $120,500, which is what we're going to capitalize and then depreciate. And then there's our change in net working capital. So it tells us there's another $5,500 increase, which would be our increased inventory less our payables, because we know our net working capital is our change in our current assets less our change in our current liabilities. So then this is how much we'd have to prepare to spend in day 1. So our cash flow for year 0 is going to be a negative $126,000. So again, if we're putting that into our financial calculators, we'd hit our CF button. Our cash flow for year 0 would be 126,000 plus or minus button to make it negative, and then push enter. Then we go down into our cash flows. So we can see each year, it's a 3-year project, we're saving $44,000 a year in costs. Now then we have to subtract from that savings our new depreciation. So our depreciation is going to be this $120,500 times the rates. So then that would be, if we come over and we say, okay, we're going to take our 120,000, whoops, now I lost my amount. My $120,500, and then I multiply that times the 0.33. That should give me my first depreciation amount. Which is $39,765. So then if we come back over here, that should be what they show us there, and that is, so the $39,765. Then we would do the same thing for that next year. Say, okay, well, we take our $120,500 and we multiply that by our next depreciation rate, which is 45%. And that gives us $54,225. And again, if we look back over here, that's what they should have. And then the same thing for year 3. So then we would take our savings, subtract that depreciation, that gives us our earnings before interest and tax. And then you could do this 2 ways. So like if I were doing this on the board, I would take the $42,035 and I would multiply it by 0.65. Save myself a step there. So if I take the 42,35 times 0.65, I get, and I'm going to round this, 2753. So then if I flip back over here to the solutions, you'll see that that's what it is. So they did it in 2 steps. They calculated the tax at 35% and then subtracted it. But again, to save yourself a step, just multiply it by the 0.65. Normally would be 0.6 if it was a 40% tax rate. Then you add back the depreciation expense. So then we get to our cash flow. So our cash flow for year 1 is going to be $42,518. Then again, if we take our negative 10,225, right? And then we multiply that by our 0.65. That gives us a negative 6646. And then we take that negative and we add back our depreciation of 54,225. We get the 47,579, which would be our cash flow for year 2. Then our cash flow for year 3, again, we do it the same way, but then we're going to come down and say, okay, but in year 3, the project ends. So we're going to get 34,926 plus our terminal cash flow. So here's our terminal cash flow. It says, okay, we've got a salvage value of $65,000. That's how much we can sell it for. But then we have to calculate, do we have a gain or a loss on that? So at the end of year 3, let me come over here and clear this out. At the end of year 3, we would have how much not depreciated. So we depreciated 33%, 45%, and 15%. So that would be 93%. So we have 7% left as our net book value. So then if we multiply that times the 120,500, oops, let me do that real quick. So 120,500 times the 0.7%, $84,035. And then if that's our net book value. So then if we can sell it for $65,000 at the end of those 3 years, we would have a $56,565 gain. And then we would owe taxes on that gain of 35%. So that would be $19,798. Okay, so let me come back over here. So that's how they've calculated this out. That $19,798 is based on figuring out, okay, what's my net book value with 7% not depreciated? Compare that to my sales proceeds. I have a gain of $56,575, so I owe the IRS $19,798. So then I would say I'm getting $65,000. I got to pay the IRS that. So my after-tax salvage value is $45,202, but I'm also going to get this return of net working capital. So if I come up here, that should be included in our final year cash flow. So, yeah, so here it is. It's kind of over here in this corner. Sorry, it doesn't lay out very nicely. But we're also going to get that $5,500. So then when we go back, we're going to put into our cash flow for year 3, we're going to have 34,926 plus 45,202 plus $505. So that's where this 85,628 comes in. So we would put that into our cash flow function and say what they've got here. Our cash flow for year 0 is the 126,000. Cash flow for year 1 is going to be the 42,518. Cash flow for year 2 is 47,579. Cash flow for year 3 is 85,628. We would put those into our cash flow function, come over to the net present value button, put in the cost of capital, which is 12%, and then we'd compute our net present value, and then we should get that same $10,841. So then that's what you want to be able to do. The only thing you also may have to know for your test is to calculate the risk-adjusted discount rate. So just kind of look over that in the textbook and understand how to do that as well.